Hello, namaste, and a very good evening to everyone. Welcome to the first 2026 edition of the Equity Market Insight webinar by UTI Mutual Fund. I am Sonal Mittal, Product Specialist at UTI, and it's great to have you with us today. Markets are full of narratives about growth, cycles, and what works well. Amid all this noise, one word that keeps coming up is value. It sounds familiar, it sounds simple, but in reality, it means much more. To help us make sense of current market environment, I am delighted to be joined by Mr. Vetri Subramaniam, our MD and CEO designate, who will share his perspectives on global and domestic markets. Joining him later is Mr. Amit Premchandani, fund manager, who will take us deeper into value investing and thinking behind UTI Value Fund. We'll keep today's session conversational and interactive, and we'll also take your questions toward the end. So please feel free to share them anytime using the link provided. With that, let me invite Vetri to get us started. Welcome, Vetri.
Good evening, everybody. Thank you for joining us here today on this edition of the Monthly Market Insight. It's the first one for January 2026, for the year 2026. So I won't miss the occasion to wish all of you and your families a very happy new year. And, May 2026 bring peace and joy to all of you. So without any further ado, we'll get going with today's conversation. And, Sonal has put together a whole series of interesting sort of data points that I think will add to, the insights that we'll be able to share with you. So I'll hand it over to you, Sonal, to, get today's events underway.
Sure. Starting with the global macro picture, while several central banks have been cutting policy rates, long-term bond yields have been inching higher. For instance, US Fed has cut rates by around 175 bips point in this easing cycle, yet a 10-year US Treasury yield is up roughly 50 basis points. Then there is the case of Japan, where yield have climbed nearly 130 bips, touching a 50-year high. What is your take on this?
You started with a very tough one, Sonal. But that is true. I think if you had asked anybody a year and a half ago, they would have expected that as many of these central banks embark on an easing cycle, there would be a dramatic compression of long-term bond yields. That has not happened. There are many reasons for this, including the fact that many economies have continued to keep their foot on the fiscal pedal. And therefore, as a result of that, even though the Fed has cut short-term interest rates in the case of the US, long-term bond yields have not responded to that because of the pressure of issuance from the center, and therefore a rising term premium on concerns both about issuance, size of the fiscal deficit, and also about inflation. Remember that in the US, even though they have cut rates, actually their reported inflation number is actually above their target level. Finally, of course, we come to the case of Japan, where we're not really discussing cuts. But the fact of the matter is that Japanese bond yields have moved up very, very sharply. This is a big change, Sonal, from previous environments where every time there was, any sort of turmoil in global capital markets, you would immediately see the yen depreciates and you would see Japanese bond yields go down. As a result of that, the Japanese bond market was the favorite borrowing ground for carry traders across the world, borrowing money in yen, a cheap currency in terms of the cost of capital, and using that to deploy it in other parts of the world where higher yields were available. So this was really the origin of the yen carry trade. But as you can see on this chart, the spike in rates in Japan has been very, very significant. Combination of high fiscal deficit, combination of the weak yen, and of course much higher inflation than their target level is, and therefore the 10-year bond yield has spiked all the way to 3.4%, highest that you can see on the chart. But in fact, it's also a 50-year high, and that does create concerns about the fact that many investors who were using this carry trade to borrow cheap in Japan and invest elsewhere in the world are now having to unwind that trade. And that could be something that could, pose a little bit of risk to financial markets across the world, particularly as far as leverage trades are concerned.
Yeah, that's a helpful way to look at it, Vetri. Building on that, while policy rates are coming down, long-term bond yields remain elevated. That keeps the long-term borrowing cost in the US particularly elevated. So, how is this impacting the health of US companies and the government? And what does it mean for the US government's balance sheet in this cycle?
Sure. That's an interesting question, that you position there. And actually, it's interesting to look at maybe first the chart on the right-hand side. If you go back to the period, around the global financial crisis, it was actually the corporate sector and the household sector which had a lot of borrowing. The government actually did not have a lot of borrowing. So when you look at the chart on the right, look around the period 2005 2010, and US government interest expense as a percentage of GDP was pretty much among the lowest numbers that had been seen in almost the past 30 to 40 years. Just about 1.5% of GDP, that was below 1.5% of GDP. That was what US government interest expenses were as a percentage of GDP. But when the GFC happened, and then as we go into the pandemic, really what the US government did is raise its debt indebtedness first to fill the holes created by the global financial crisis, and then to pump money into the economy and backstop consumers. They literally put money into consumer wallets, and as a result their debt as a percentage of GDP went up. As a result of that, what you're seeing on the right hand side slide is that interest cost as a percentage of GDP has also spiked now to almost about 3%. This is pretty much a record level for the US. In fact, now interest as a percentage of their budget is one of the biggest numbers in their budget. It in fact exceeds the amount that they spend on their defense. Simultaneously, the corporate sector has actually continued reducing its indebtedness ever since the global financial crisis. So if you look at the left hand side, you can see the dark line, which is non-financial corporates, net interest expense, and below that you can see non-financial corporate net interest expenses. So when you look at that, what you will see is that both lines actually have a declining trend from around the time of the global financial crisis. And this is what really reflects to you that corporates have actually reduced their leverage over the past decade, whereas it is the government which has increased its leverage over this period. And therefore, as a result of that, non-financial corporate net interest expenses have actually declined in absolute terms. And of course, they have also declined as a percentage of their pre-tax profit. So as a result, I would argue corporate balance sheets in the US are broadly healthy. Non-financial sector balance sheets are broadly healthy. It is the government sector which is really now under pressure in terms of interest expenses. And of course, as we are well aware, they are continuing to run fiscal deficits of 5 to 6% of GDP a year. No sign of it coming down. And therefore, their debt to GDP is likely to cross 120%, highest it's ever been in a, so to speak, peaceful period, not when World War II was going on, but during a period of peace. This is pretty much the highest that they've had. So this is where we are. The US government in particular is overstretched. Corporates are in good shape.
Oh, that was quite an insightful context. Let me shift gears to a bit into a longer term structural theme. There's been a lot of discussion around AI. You also touched upon tech-led capex in your recent commentary. From what we are seeing so far, how is AI impacting jobs and productivity?
Sure, Sonal, that's an interesting question. And, there is some data, of course, that's been published. But I must say the anecdotal commentary on this is still all over the place, because there are people who will tell you it is completely changing the world. And there are people who say nothing has changed. It may well be the case that those who are saying it's going to change the world are looking at what is going to happen. Those who are saying it is not showing up are merely looking at the data as it exists today. And therefore, that that could really be the disconnect. But I think the more interesting point to really think about is that in the longer term, what US economic data has shown us is that when productivity increases, real wages increase along with that, right? So therefore, if you think about it from the point of the aggregate economy, productivity has a positive impact in terms of real wages. Doesn't mean that everybody is experiencing the same outcome. There could be segments of the population who are actually not benefiting from this, and other segments which could be benefiting from the productivity boom. But the data tells us that there is a positive correlation, and also productivity is positively correlated with tech investments. So as you rightly said, Sonal, in the last call, we talked about the large investments going into productivity. Now, what will into AI capex? Now, whether that will create returns for shareholders, we don't know. That is, the jury is still out question. But clearly, productivity does tend to have a positive correlation with tech investment. So, from a macro perspective, we should expect that eventually over time, the data and or rather the capex which is happening in AI will lead to productivity improvements, and those productivity improvements will lead to real wage growth. What this does not tell us is whether real wage improvements will be widespread, or it will be with only certain segments of the people and their occupations.
Now, you have put this very clearly, bringing the discussion closer home. Budget 2026 is approaching and nominal growth has slowed. So, how do you see the fiscal trajectory evolving from here? Should the government lean more towards supporting consumption or continue to focus on capex-led growth?
That's an interesting dichotomy you're posing, Sonal. First of all, I would guide many of you, if you have not read Anurag Mittal, our head of fixed income. He wrote about the great fiscal divide just earlier this month. It's a blog that he published. Do look it up on our website. But what that will really highlight to you is very different compared to our previous conversation when we talked about the US. India has actually stayed fiscally disciplined over the last decade, and particularly as we have exited the post-pandemic period. So again, start on the right side. When you see the central government debt to GDP number, you can see over there that the trajectory was very flat between 16 to 20. So, as I said, we stayed very disciplined. This is, of course, only central government. We're not talking about the states. Then, of course, the pandemic year comes, the fiscal deficit goes up. So your debt to GDP goes up to 60.7%. But every year since then, India has been bringing down the fiscal deficit from a peak which was above 9% of fiscal deficit. This year, we are estimating that it could be somewhere in the region of 4.3 to 4.4% of GDP. So effectively, we have significantly brought down the fiscal deficit. And therefore, now the government is actually saying that they would like to now focus on bringing down debt to GDP. And their target is to bring down debt to GDP by FY31 back to the level of closer to about 50%. So unlike the US, where debt to GDP is expected to climb, in India, we are actually expecting it to actually continue trending lower. Fiscal deficit may or may not trend significantly lower, but debt to GDP will certainly trend lower. That's the government's thought process. So India will remain fiscally disciplined based on the path and trajectory we have articulated for ourselves, unlike perhaps the US and certain other geographies. As far as the breakup of expenditure is concerned, that's a function of how tax revenues play out in the short duration. Keep in mind, Sonal, that in the last 1 year, government already delivered a large income tax cut. Then it delivered a GST cut. Both of these benefits actually flow to consumers. And therefore, to that extent, I would say government has already done a lot for consumption. I believe it would be a very big stretch for government to once again do something on the direct tax front, considering that they have already done something in the previous budget. So my sense is they will stay on the path of discipline, and they will do whatever they can in terms of leaving money in consumer wallets, and they will also do whatever they can in terms of increasing the capex where possible. Because on capex, increasingly one of the insights that we pick up in our conversations with government in Delhi is that there are limitations to the government's ability to do capex capex beyond a point. They can provide incentives to the private sector to do capex like they did through PLI, and maybe that is what they will continue to do where possible, rather than directly engage in capex, because there is a limited number of sectors in which the government can actually drive capex at this point of time. So I would expect discipline to continue, and I think there will not be much to choose between consumption and capex. Whatever is within their capacity, they will do as much as they can over there.
Those were some really interesting points to look at, Vedri. Moving ahead, while the headline indices are close to their all-time highs, many investors feel their portfolios are down meaningfully. Do you see this divergence as well, and what's driving it?
Good question, Sonal. And it is a bit of a stealth correction in the sense that sometimes the indices don't fully capture the damage which is happening in the marketplace. You can see that on the table on the left. This is data as of 9th of January. So you can see that the market, the Nifty 100 large cap index is down only 2% from its 52-week high, 3% from its all-time high. Nifty mid cap index again 2% from the 52-week high, 1% from the all-time high. But then you go to the Nifty small cap 250, down 18% from the 52-week high and almost 29% from the all-time high. So you start to see the gap open up. Then you go to the individual companies. So if you take all 500 companies in the index and you arrange them by, are they up or down from their 52-week high, you find that, the median fall for the Nifty 500 companies is minus 18%. So roughly speaking, there are 250 companies in the Nifty 500 which have a fall of more than 18% from their 52-week high. So that tells you that the damage in individual companies is much more than in the benchmark, because benchmarks are market cap weighted. And if you just want the number of companies which are down more than 30% from their peak, 52-week peak, 21% of the companies are down more than 30% from their peak. So that just gives you the sense of how, whereas the index has been sideways because of movements within companies, and obviously that reflects more of the large cap bias because they have the larger weight in the benchmark indices, at a stock level, the damage has been a lot more significant. And of course, on the right side, we have also shown you what this data looked like in 2018, which also was a period of correction. And I would say when you look over there in the previous cycle, the damage was apparent both in the index and in the Nifty 500. Maybe today it is not yet visible, but then again, we don't know whether we are at the same point of time as of today as compared to where we were in December 2018. Because remember, in December 2018, the market had already been falling from its high for about 11 to 12 months. So there is a difference in time period at which we are looking at this today as compared to what we were looking at in the right side table. But to cut a long story short, indices are not capturing the damage. Large caps have done better than mid caps, which have done better than small caps. Actually, mid caps have done reasonably well. It's the small caps where the damage is more visible. And that's why when you look at Nifty 500, the 250th company in terms of performance is already down minus 18%.
I'm sure many of our viewers will relate to that, Vetri. Following on from the previous question, we also appear to be experiencing a change in the trend of large caps versus small caps. How should investors think about this?
That's a good question, Sonal, and this is something that we have talked about, several times in the past. Of course, we never claim that we have a crystal ball, or for that matter, a bell which tells us when mid caps will start outperforming large caps or when large caps will start outperforming small caps. But we do have a thermometer, and that thermometer tells us what is the level of valuation in the market. And when valuations are rich, what history has told us is that forward returns get depressed. When valuations are cheap, forward returns improve. That is the lesson from history. We have been reiterating this for almost, I would say, the last 2 years, that we are more comfortable with large caps as compared to mid caps and small caps. And what we've shown here on this table is the 1-year performance of large. So large has actually got two representatives here, Nifty 50 and the Nifty 100 TRI. Then there is the Nifty Mid Cap 150, and then finally you have the Small Cap 250. If you look at the 1 year return, the Nifty 50 is up almost 12%. Nifty Small Cap is actually down minus 5.5%. You look at the 2 year return, the Nifty 50 TRI is now up at about 11% number per year, whereas the Nifty Small Cap is underperforming that at about 9.7% a year. So that gap is starting to open up, and I would submit that this is essentially the impact of the temperature reading 2 years ago, where one segment of the market was more richly valued as compared to the other, and eventually it is starting to show up in the forward return. So this is pretty much the picture of something that we've been talking about for a long time, and we are now able to see it. Just one more data point I can share over here, which you can see on the next slide, which is no doubt, I think it is wonderful to see the level of capital mobilization which is happening in India. More and more companies coming for IPOs, more and more participation from retail investors, from mutual funds, insurance companies, FPIs, all of them. As a result of which, the share of market cap with mid caps and small caps has gone up. Because remember, our definition of large caps is the top 100 companies in the country. Then it's followed by the next 150, and then the bottom 250. So as a result of this, when you look at the market cap based on this construct over time, what you will see is that the current share of the large cap companies in the 500 sort of stock index is just at about 68%, which is pretty much its lowest number. If you go back almost 15 years, that number used to be as high as 80%. Today, the mid and small caps are closer to 22 and 10%. It's not just, I would say there are multiple factors which have gone into this. One is the new listings, and second is the high valuations in the mid and small cap space. So all of this combined together has raised the trend of, share of large caps, or rather increase in share of mid caps and small caps relative to large caps. Is this necessarily mean reverting? I would not consider this a traditional mean reverting number, but everything in financial markets has cycles, and therefore when you see that this is at a 15-year low, I would expect at some point this cycle will move in the opposite direction.
That sets the context very well. Now, if we move from macro to markets, how did markets behave over the last month, and where do valuations stand today?
Sure, Sonal, we can just jump through on that. I won't spend too much time on this. If you just look at the extreme right, you can once again see Nifty 50, Nifty 100, and how the small caps are really the ones which have underperformed. You can also see below that what's leading the market on a 1 year basis. PSU banks leading the pack, but good to see financial services and bank as well doing well. That's been one sector that we've been consistently calling out, and of course, the auto sector as well did phenomenally. We of course run a transportation and logistics fund, so that has benefited from this move quite significantly. And the other, strong performance has been from metals. So it's not just precious metals, gold and silver, which have done well. Even a lot of the industrial metals have actually done quite well, and their stock prices have also done well. IT is one of the disappointing sectors that you see there at the bottom. Moving on from that to the next slide, this is really sort of, geographical performance. It's been a disappointing year for India, up 10.5%. And I think these are the rupee numbers. In foreign currency, it might look even slightly, worse than the others. But you can see that there's a whole host of emerging markets which are doing better. I sometimes see people talk about, oh, it's an AI trade, only AI is doing well, and that's why India is not doing well because there's no AI in India. But fact of the matter is there is no AI in Brazil either, but it's got phenomenal performance. South Africa has phenomenal performance. There's no AI over there as well. Greece has got fantastic performance. It's not in this table, but last I checked, it was up 60% on a 1 year basis. There's no AI in Greece either. So I would say there's been a very strong rally in many markets across the world. In fact, in US dollar terms, the US has been underperforming many of the other EM markets and also developed markets. So it's underperforming Germany, France, those countries as well in US dollar terms. So yes, in the US, AI has been best performing, but if you look around the world, there are many markets which have nothing to do with AI, which have done spectacularly well. But we can move on from this to talk about the normal stuff that we do. So this is the earnings expectations, March 26, 8% estimated growth in Nifty earnings. The estimate for March 27 is 17% earnings growth. This is a very high expectations for March 27. One reason for that I can show you on the next slide. This is the number of companies in the Nifty 500. So of course the previous slide was Nifty 50, but this is the number of companies in the Nifty 500 where on a year-on-year basis, both revenues and profits are growing faster than 10% year on year. And you can see that in recent times, the number of companies where revenue is growing faster than 10% year on year has been only about 50%. And in profit terms, it's just slightly below 50% of the companies which are growing greater than 10% year on year. So 17% year on year, even though it's for a smaller universe, which is the large cap companies, is a very high bar, because when revenue growth for such large companies is running at only 10%, it becomes very difficult for them to convert that into 17% profit growth. If you ask me, why is corporate India growing at 10%? Very simple reason. Somewhere corporate growth numbers are related to GDP growth numbers. Of course, India's GDP growth at 8%, blew the lights, above 8%, blew the lights out for the last quarter. But nominal growth was also just less than 9%. So, corporate revenue growth is closely aligned with nominal GDP growth outcomes. And, that means it's a very high bar to get 17% earnings growth next year, even though I know there are a lot of base effects and all of that. But if nominal growth is going to be 10%, it's not easy to generate 17% profit growth out of that. Moving on from that to the next slide. Standard charts on valuation. On the left hand side, Nifty trailing price to earnings multiple. As you can see, it's in the white zone. It's fairly valued. Forward PE multiple is in the expensive zone. Though it has sold off from the peaks that it had earlier in 2021. Next slide, you can see the price to book ratio. This is, of course, once again, very much in the fair value zone. And the good thing is that it is in the fair value zone, in the white zone, 3.2 times price to book, when return on equity is still closer to 10-year highs than 10-year lows. So, I think there is a good sort of balance that's happening in terms of where the price to book is for the Nifty 50 and where the ROE is. However, when you go to the next slide, where you'll see the mid cap and the small cap valuations, this is where the dichotomy kicks in. Yes, mid cap's price to book has dropped, but it is still in the expensive zone. It's more expensive than large caps at 4.5 times price to book, and Nifty small cap at almost 3.5 times. So that also is at a premium to the large caps. Moving on from that, this of course is our bond versus stock indicator. I won't spend too much time on this. It's still in the zone where it's saying fixed income favorable, but of course not as much as it used to be earlier. But Sonal, we can just go to the next slide, because I think over there we will be able to talk about our valuation indicator. So we can maybe pull up our valuation indicator over there. Yeah. So this is our valuation indicator. This is a combination of many valuation indicators. It has a large cap bias because it is based on Nifty 50 data. The good news is that when you look at the large caps, the indicator is in the yellow zone, which is the fair value for equities. It had some time back come even to the green zone, which was increased equity allocation, but today it is in the yellow zone. How to interpret this table? How can you use it? What are the outcomes like based on historical data? You will be able to see that on the next slide. Yeah. So in line with the decreased equity allocation zone, you can see that based on the last, I think, about 14 years of history, when you invested in the orange zone, which is the decreased equity allocation zone, there were 28 observations. The average one-year return is only plus 3%. And the probability of making more than 12% on a one-year basis is close to zero. The number of instances are actually zero. Similarly, the maximum one-year return, of course, is 10%, but the minimum one-year return is minus 4%. And then as you keep going down that table, you can see how the numbers start to move. And in that bottom row, where it says significantly increase equity allocation zone, you can see that the data moves completely in your favor, because when you invest in that dark green zone, your average 1 year forward return is 35%, and 95% of the time your 1 year forward return is greater than 12%. That is why making a asset allocation shift in favor of equity is a good thing to do when the market is in that green zone. It is not a great thing to do when the market is in the decrease equity allocation zone. So that's the simple way to interpret this table. Finally, what do we have after this, Sonal? Yeah, okay. We've got the key takeaways. We've already talked about a lot of this. Global growth trends are mixed. US growth remains strong, but I would say most other parts of the world growth has been sort of mixed. And even in the US, a lot of it is driven by AI related capex. India's macroeconomic fundamentals are in very good health. Fiscal and monetary policies are supportive. The government's policy agenda in recent times, whether it is the withdrawal of quality control orders, it is the new labor codes, opening up of new sectors like nuclear to FDI, increasing FDI limits in sectors like insurance, all of these are supply side measures. The thing about supply side measures is that they don't convert into growth next quarter or tomorrow or next year. But over time, they create the kind of supply side momentum which can actually increase the sustainable growth rate of the economy, because it brings in more capital and more opportunities to entrepreneurs. So we are well poised for nominal growth acceleration this year as compared to the last 2 years. Why? Because inflation is going to be higher, and we do expect some general pickup in economic activity. We think the government will likely be prudent. We've already talked about earnings. Which is to say that the 17% bar for March 27 is a very high bar. I would be a little bit concerned about that. Our in-house equity valuation indicator, which is only talking about large caps, is now in the fair value for equity investing zone. We think this is an area or time when investors should still prioritize asset allocation and risk management, and the bias still remains in favor of large cap stocks. So I think with that, I'll halt over here, Sonal. Hopefully we've managed to provide viewers with a overall sense of the opportunities in the marketplace and how we read the tea leaves in the marketplace at this point of time. But happy to hand over to Amit Premchandani, who's also been my co-manager during my fund management days when we used to co-manage the UTI Value Fund. He successfully has now stewarded the fund single-handedly for I think almost coming up soon to 5 years. So he's done a fabulous job of that. But I'll hand over to him, and he'll take you through a presentation on the UTI Value Fund.
Sure. Thank you, Vetri. That gives us a strong macro and market backdrop. Welcome to the webinar, Amit. So, Amit, value is a word we often use, but rarely pause to define. Before we go deeper, let me start with a foundational question. When you look at a stock, what tells you that there is a value there? How do you define value?
Thanks, Sonal, for the question, and thanks, Vetri. Happy New Year to everyone. In terms of how we look at value, it has progressed, or it has been consistently followed over the last 7-8 years since this fund was classified as a value fund. We try to buy business or focus on buying business which are trading below the intrinsic value. So we do not rely on the statistical cheap valuation framework to construct our portfolio. We always focus on buying stocks which are trading below intrinsic value. And we also look at stocks where expectations are low at the time of building a position. And our approach consists also on looking at various quality aspect while incorporating value. We focus on quality on capital allocation of the management, whether any terminal value risk is there because of change in technology or climate change, which can lead to value traps. Instead of focusing on accounting profit, we focus on cash flow, whether the company is converting sufficient percentage of EBITDA to operating cash flow, whether the capex commitment of the companies are in line with the cash flow generation that it has. To take exposure to cyclical sectors, we focus on where the sector or companies are in terms of the operating and profit cycle of that sector. And most importantly, we look at corporate governance. Many stocks are on a headline basis of value because of genuine reasons of governance issues. So we have a high cutoff in terms of corporate governance. We not only look at historical valuation of sectors to judge where we are in the cycle, we also look at how the underlying business dynamics of that sector or companies may have changed over the period. So we are not completely wedded to history. Recently, you would have also seen that many new sectors, companies driven by digital economies have come to list. And from a value fund point of view, it is very difficult to judge it from a value or a traditional value framework point of view because there is hardly any cash flow that they generate. To invest in such kind of businesses, we focus on the unit economics. We take only small exposure to these kind of sectors, given that valuation are very rich. So our approach or our philosophy of approaching value within the prism of intrinsic value gives us enough flexibility to invest in companies which have various kind of option values which are not discovered by the market. It widens the scope of the investable stocks in our universe because we are not only focused on multiples, and it also reduces portfolio volatility, which also reduces the return divergence with respect to benchmark. We have a set of guardrails which we use while investing in the portfolio, and our primarily valuation guardrail is at a portfolio level. The valuation should be significantly cheaper than the benchmark on a price to book basis. So that is how I would describe how I approach value as a concept in the UTI Value Fund.
Sure, Amit, that leads to me to a natural follow-up. Quite often, a stock may appear attractive purely on the valuation metrics, but experience tells us that not every cheap stock turns into a good investment. So, what are the key filters you apply to separate genuine value opportunities from value traps?
So, as you can see in the table there on the right-hand side, we try to avoid companies which have balance sheet stress. That is the primarily filter that we use because companies which have balance sheet stress have mortality risk. So we completely avoid these companies. We also look at avoiding companies which are operating in secular low growth sectors or operating in an environment of degrowth, because they will always remain cheap. India is a growth oriented market, and hence if the companies are operating in a low growth environment or a degrowth environment, they will kind of classify as a value trap. So we avoid cigar butt investing approach. Sectors of company which have poor cash flow or have reinvestment risk are also avoided. And we have very high cutoff to buy companies which are operating in a sector which we think is in a terminal risk kind of sectors like energy or traditional media. We have much higher cutoff in terms of investing. Finally, our focus on cash flow rather than accounting profit lead us to avoid companies which are value traps. And our focus on avoiding leverage also helps us avoid companies which are value trap. This also leads to the portfolio quality being better than peers because our focus remains on cash flow and financial leverage.
That really explains the process. Now let's bring this philosophy into practice. When investors hear the term value fund, it's often simplified as buying low PE stocks, but in reality, executing value, it requires discipline, patience, and a clear process. So could you walk us through the investment strategy of UTI Value Fund? how it defines value, balances valuation with business quality, and construct the portfolio across different market conditions.
So we primarily use three levers to create the who focus on portfolio construction. The first lever is sector allocation, which is completely driven by valuation filters. We focus on investing in sectors where valuations are attractive. And we also look at the operating cycle or valuation cycle of that sector. We try to avoid narrative driven sector allocation. As you can see, we moved over. So the chart reflects how we use valuation at a sector level to increase or reduce exposure. For example, in automobile, we have been very conscious about valuation and increased sectoral exposure when valuations were reasonable. And we have been consistently having a very significant underweight in capital goods sector over the last 2 to 3 years, completely driven by valuation approach. So we look at implied growth to judge growth-oriented sector valuations, how they are placed as compared to their history in terms of growth and what is the market price implying. And in asset-oriented sectors or asset-heavy sectors, we focus on price to book as a valuation benchmark. Just to put it in context, in the last 1 year, our sector allocation to BFSI and IT be, would reflect our primarily focus of sectoral allocation based on valuation. Also, the recent profit booking in metals is driven by the same process. When valuation moved up significantly, we turned from a significant overweight to a underweight. The second lever which we use is what we call a asymmetric barbell approach. And that asymmetry comes from our favor to value and give a much more value tilt in terms of stock picking. Here, we buy both growth and cyclical stocks. But when we are buying cyclical stocks, we try to execute a contra strategy by investing in stocks which are going through temporary profit and loss issues, no balance sheet concern. The issues are largely driven by the cycle, and we try to buy stocks when they are on the where they are in the down cycle, as far as cyclical stocks are concerned. As far as the growth-oriented stocks are concerned, on the other side of the barbell, we try to buy stocks which are available at reasonable valuation and have long runway of growth as far as growth-oriented stocks are concerned. But what we focus in on both the side of the barbell is to buy stocks where expectations are low or expectations are reasonable. We don't chase stocks. We don't focus on chasing momentum. And actually, we avoid buying momentum-oriented stocks. The third lever is to invest across market cap, large, mid, or small cap. We find wherever the valuation is comfortable, we try to change our market cap allocation. But this lever is not being used very frequently now. Although we think that large cap valuation are much more comfortable than mid and small cap, our allocation to mid and small cap has been pretty much in the 30-35% range over the last 1 to 2 years. One important point to note here is that we have allocation to durable sectors, which is largely a small cap oriented sectors, which is going through the cyclical low. Also, frequent changes in the market cap capitalization, which are more which are 6 monthly, also distort the market cap exposure numbers. So, but these are the three levers which we are using to construct the portfolio. Stock specific valuation is important at the time of entry, whether it is on a relative basis or absolute basis or based on history. But exit depends on many other factors, including valuation. So we do not just exit stocks because valuations have become relatively more expensive. We want to participate in the entire valuation journey of the company if we have identified the stock in a reasonable or a cheap valuation, rather than exiting the stock at the first sign of valuation comfort. So we run a more nuanced kind of a value fund, having a nuanced approach. Our strategy is to deliver consistent return and avoid the heightened volatility often seen in fully cyclical portfolios.
That was very insightful, Amit. Thank you for laying out the framework so clearly. Now, taking this from philosophy to execution, over the last 12 months, markets have seen sharp rotations, valuation corrections in pockets, and changing earnings expectations. How has the portfolio evolved during this period? What changes have you made in response to changing or shifting valuations, fundamentals, or market conditions?
Yeah. As far as the portfolio changes are concerned, as you can see, the largest exposure in is in BFSI, and the largest active weight is also in BFSI, almost 4% active weight at a sector basis. So we have gradually increased our exposure to BFSI, made changes also, and this comfort, especially on banks, is coming from the factor that regulatory environment over the last 1 year has turned very benign. Banks continue to report high ROAs, high ROEs. Loan growth has already accelerated to double digit. Uh, Asset quality is more or less pristine, and they are adequately capitalized to grow. So we have consistently maintained high overweight in BFSI, and valuation is also comfortable. Over the last 1 year, a significant positive active change was done in automobile. This was on the back of the direct tax cut, which was announced in the budget. We thought that this will stimulate passenger vehicle demand, so we increased our exposure to passenger vehicles. Penetration level in India is low as far as passenger vehicle is concerned, and valuation was reasonable as compared to other consumer-oriented name at that point of time. We continue to have a significant overweight exposure, and as I said, we just don't sell the stocks at the first sign of valuation discomfort. So we will continue to hold on to that overweight exposure. We think we are in the early stage of the cyclical upturn in passenger vehicle. Real estate was one sector which saw significant underperformance last year, and we have highlighted that we are significant underweight in real estate because valuation moved to a narrative format. People started, or market started, focusing on price to EV EBITDA or PE as a matrix of valuation for real estate, which was never the case during previous cycles. And these are all signs of market finding it difficult to justify valuation based on NAV framework. Given the significant underperformance of last 1 year, and specific stocks have much higher underperformance, and the salience of commercial as a percentage of NAV has moved up significantly on many stocks, and commercial is less volatile, less cyclical in terms of valuation, we have again moved our exposure higher to real estate and added a real estate name over the last 1 year. Metal is one sector where the cyclical sectors, we were early in terms of having an active overweight and maybe early in moving to an underweight. We just moved underweight last quarter in December, and that was primarily driven by the fact that valuations had inched up significantly. Margin profile of some of the companies were at cyclical high, and there was an element of narrative which was driving the re-rating. I'm not sure whether the narrative is right or not, but we are slightly discomforting. It was slightly discomforting. However, we think that within the metal sector, ferrous is one sector where fundamental factors have started playing a part because a government has introduced safeguard duty for a 3-year term, which is a positive surprise. So that element is not narrative driven, and we are kind of exposed to ferrous. These are the broad changes we have made at an overall level. We have focused more on consumers and continue to have a significant underweight in capital goods.
Yeah, that gives our viewers a good sense of how actively you are managing this portfolio. And staying with this thought, one question we often hear from investors is around performance. How has the value strategy performed relative to the broader market over the long term?
So over the long term, as you can see, that value strategy has done well as compared to the market. It has done really well over the last 10 years, and that is mainly to do with the fact that from 2021 to 25, value as a style has done really well, which took out the which compensated for the underperformance of value as a style, which we have seen from 2012 to 2020. So on a long-term period, value as a style does better or in line with the market, but it is accompanied by much higher volatility. So investors who are focused on or looking to invest in value as a style should expect higher volatility and in line or better than market returns combined with that volatility.
Thank you, Amit. That really ties together the process, portfolio, and outcomes. We have also received several questions from our audience. So let's now move to the Q&A segment. Petri, my first question is for you. Market sentiment weakened recently after reports of proposed US tariffs on certain imports, which caught investors quite by surprise. How are you reading this development, and how significant could this impact be on the markets?
Well, hard to say. I mean, I think it's more sentimental. I mean, honestly, most Indian exporters would tell you that even with that extra 50% tariff, they're really struggling. So 500% becomes sort of a theoretical number, right? And I think some of this is just, more negotiating and deal making tactics rather than really being the reality. And it was interesting to see that, yesterday when there was some rumor that, oh, there's going to be a trade deal, the market reacted positively. Actually, neither do I understand why the market reacts positively or negatively to the thing of a trade deal, because we have already talked about this earlier, Sonal. The percentage of exports to US which are impacted by tariff is a very small number. It's basically 50 odd billion of our exports actually get impacted by the tariff. 30-40 billion is not even impacted by the tariffs at all. In a $4 trillion economy, that is a small number. Now, not to say that certain sectors, certain people employed in those sectors will not get significantly impacted, but I think the economy can handle it. So I think we are laying too much emphasis on that, but we will see. I think all of this is bargaining tactics, and in some senses geopolitics now resembles a multi-act play. So just keep watching out for surprises in any good play that you would see in a theater.
Coming to you, Amit. How does the value strategy or value funds strategy adapt when markets are expensive or when value opportunities are scarce?
So we have to be conscious about the fact that we have to navigate our portfolio within the framework of intrinsic value in different market environments. So shall we stop looking at historical valuation of sectors to judge where we are in the cycle? Clearly, no. For example, power sector was having a dream run in 2024-25. Price to book was 2 to 5 times of private sector power players. We didn't succumb to that. We thought that valuation are very expensive in a regulated sector. Shall we adjust our weightage on portfolio based on dominant narratives? No, we kind of completely avoided narratives or participated in a very minor way, like in solar. We completely avoided capital good driven narratives in the 2023-25 cycle, largely avoided that. We continue to focus on cash flow profile. It remains paramount for us. We didn't change our valuation framework for real estate investment in 2024 to justify expensive valuation. We completely avoided or moved out of the sector in 2024. Finally, how relevant is the demand supply dynamics of sectors which we use to participate in cyclical sectors? Can we avoid looking at that? We cannot avoid looking at that. We have to be conscious about that. That's why we are underweight on cement, given that there are huge supply which is coming. So we have to approach our valuation style within the intrinsic valuation framework and navigate different market cycles. Since we follow a barbell approach, we have the flexibility to steer the portfolio to relatively less expensive sectors or stocks during environment of excessive optimism, where value and cheap and low quality value is doing is having exuberance. That is what we have done over the last 1 year by focusing on cheap quality rather than expensive value. So this is how we have navigated the environment. That is why you see we have used automobile as cheap quality, IT as cheap quality, rather than buying capital goods as expensive value or real estate as expensive value in 2024-25. So in different market environments, we have to play differently. It depends. Basically, to take a cricket and analogy, if it's a full toss, we will go for a six. If it's a Yorker, we have to just defend. So that is what we are doing over the last 1 year. We are trying to defend.
Sure. Following up on that, Amit, how do you think about diversification and risk control within a value-oriented portfolio?
Thanks, Sonal, for this question. It's a really asked question. So we have a philosophy of avoiding all underweight exposure in the portfolio. So we do not have any underweight exposure in the portfolio. Either we have the exposure or as zero, or we are overweight. There are only one exception in the portfolio right now, and that is because of one of the largest weight in the index. So we completely avoid underweight exposures. Active weight in the portfolio has been in the range of 60 to 65 for the last 2 years, while the 5 year range has been broadly 60 to 70%. Single stock highest active weight is a function in the portfolio of where the market valuation is. When valuation are really cheap or really comfortable, our single stock active weights have been as high as 4% in a single stock. But in the current environment, we think we would be very uncomfortable to move it beyond 2.5% a single stock active weight. As far as the sector weight, highest weight in the sector is concerned, we have moved to as high as 35% right now in BFSI, while we have an internal cap of 40%. The portfolio is well diversified across sectors with even exposure to digital economy stocks, although we have very limited exposure given the value orientation. The portfolio standard deviation as well as beta, despite being a value oriented portfolio, is lower than the benchmark based on historical measures. Finally, the core of the portfolio, or the core of the investment philosophy, which is the score alpha approach that we use, the portfolio level R1 exposure is now at 60%, which is significantly higher than the benchmark now, while the consistent cash flow profile company exposure is in the 85 to 90% range. This implies that the portfolio quality is relatively much better, not only as compared to the benchmark, but also to the peers that we look at, based on the consistency-based quality measures of ROC and cash flow profile, which we look at.
Sure. Thank you, Amit. Vetri, coming to you. Equity markets are facing a mix of challenges. Valuations haven't fully corrected while earning expectations remain high. So how do you assess the equity outlook as we move into 2026?
Sorry. Yeah, so Sonal, I think we are still in sort of tricky territory. As I said, the focus should still be more on asset allocation. It should be on risk management, because I do think you are still moving through a period where, valuations are reasonable in some segments of the market, like in large caps, which are fair value, but not so much so in other segments of the market. You are dealing with certain geopolitical headwinds. It's still an evolving situation. I would be more comfortable if, the valuations were attractive in terms of being very cheap, and geopolitical situation or headwinds were still visible, because then the valuations would give me the comfort. That's the temperature check, which is most important. Today, I think you're just stuck somewhere in the middle with a slight bias towards large cap. So I would still say To my mind, fixed income giving you returns of, somewhere around the 7% mark, high quality portfolios. Combine that with equities where return expectations in the near term are maybe once again more single digit, then, you're getting a reasonably blended hybrid portfolio with opportunities to rebalance perhaps at some point of time. So I do think the hybrids are really, a good way to participate in the current market rather than just look at pure equity funds. Of course, if you're investing for the very long term through an SIP, then honestly, the best thing to do in an SIP investment strategy is to stay with the SIP through all parts of the cycle. So, that you should certainly continue. But otherwise, hybrids would be my sort of preferred go-to investment vehicle at this point of time.
Those were some really great, insightful advices, Vetri. Considering time, I will take a pause on Q&A right now. Thank you, Vetri and Amit, for those insightful perspectives. We have covered a wide range of topics today, from global macros and interest rates to fiscal dynamics, market valuations, and evolving role of value investing in current environment. So if there's any one key takeaway from today's discussion, it's that markets may continue to throw up noise and short-term volatility, but staying disciplined, patient, and focused on fundamentals that remains critical for long-term investing. Thank you to all our participants for joining us today and for your thoughtful questions. We hope today's discussion helped provide clarity and context as you navigate the markets. We look forward to having you join us again in our next Equity Market Insight edition. Have a wonderful evening and thank you for being with us.
Thank you, everybody. Thank you, Sonal.
Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.